morning, everyone. Great to have you here. This is, of course, Nairametrics Economic Outlook. We know that so much has been going on, especially recently with the CBN policies. So we hope to dive into that today with the Economic Outlook. We have an amazing lineup of guests who will be taking us through and giving us insight into what's happening. I recall sometime last year, late last year when the CBN governor was appointed, a lot of people were saying that perhaps the pace was slow. I mean, that was the public perception, but in the last 2 months, he has basically come in pretty much like a wrecking ball. So many policies, so many circulars. So that's the discussion today. What direction are these policies pulling our economy in? What are the achievements, short term, long term? Is it sustainable? What's next? Have they used up all the weapons in their arsenal? So, I mean, that's the conversation today. I am Joanna Mustafa. I'll be moderating alongside Rota Sodiri. And yeah, like I did say, we have an amazing lineup of guests. We're going to begin, of course, by appreciating and acknowledging, recognizing our headline sponsors for this Economic Outlook webinar, the Nigerian Mortgage Refinance Company. They're on a mission to break down barriers to home ownership by providing liquidity, affordability, accessibility, and stability to the housing market in Nigeria. They're able to achieve this by leveraging funding from capital markets to enhance mortgage access, promote affordable home ownership in Nigeria, and unlock the multiplier effect of the housing sector on the Nigerian economy. So, I mean, the idea for the NMRC is to encourage financial institutions to increase their mortgage lending by providing them with long-term funding, to increase the maturity structure of the mortgage loans and assist to reduce mortgage rates, amongst much more. We're going to run through their achievements much later on, but we just thought to begin by recognizing them as our headline sponsors for today's Economic Outlook webinar, CBN Policies and its impact on the wider economy. As I did say, of course, we'll have a presentation and then we'll have our panelists who will be providing us insights. I'm just going to begin by running through their profile as well. We have here with us Dr. Abiodun Adedipe, PhD, FCIB, and FLOD. He's the founder and chief consultant, B. Adedipe Associates Ltd, with about 4 decades of postgraduate work, and professional experience that cuts across university teaching, investment banking, project finance, management and financial consulting, as well as leadership in business and business for non-profit organization. Abiodun has had illustrious career that has taken him through the University of Lagos Enterprise and Consulting Group, the World Bank Africa, the World Bank Africa region, International Merchant Bank PLC, and First City PLC, and First City Monument Bank PLC as well. Abiodun's technical expertise is wide-ranging, covering corporate strategy, research and economic analysis, solving complex business, amongst many other things. So ladies and gentlemen, let's welcome Dr. Abiodun Adedipe. Real quick, we're going to move on to Dr. Bumi Bajomo. She is the head group corporate banking and chief operating officer with a BSc in economics, first class honors, MSc in economics and finance, ACIS, ACIP, MCSI, PhD in economics, the specialization being international monetary economics. So I mean, the pedigree is massive. Until joining ETI, the group head corporate banking manufacturing at First Bank of Nigeria, where she was responsible for the development and execution of a robust corporate business strategy that meets the needs and delivers best-in-class solutions to the bank solutions manufacturing sector clients, with direct responsibility for Nigeria and across subsidiaries in the bank's global footprint. I beg your pardon, there are a lot of typos in here. Yeah, we have to recognize her presence here. She has a strong credit networking and organization skills. She was appointed to pioneer the establishment of Citibank Nigeria, expanded Citibank Nigeria's local corporate business in 2010, where she's on the board several notable corporate names within the first few years of operations, built on strong credit ethos, with no cost of credits incurred. Most of these clients have grown and have remained dominant in Nigeria's corporate landscape till date. She was selected for the Citigroup's coaching for Success Leadership Program for high potential women across Central and Eastern Europe, Middle East, and Africa in 2012. She left Citi to join Coronation Merchant Bank as a pioneer divisional head and director of corporate banking, where she built the corporate banking business of the bank from the ground up. So, I mean, we recognize your presence and we appreciate you being here, Dr. Bumi Bajamo. Let's move on real quick to our next guest, in person of Professor Onokoya, PhD, FCA, FCIT, a faculty member, Department of Economics, Babcock University, Ogun State. Professor Onokoya is a rare double professional appointee, Professor of Business and Applied Economics, Crest University, Nigeria, 2016, and Professor of Development Economics at Babcock University, 2021. He has a BSc in Economics, MBA in Marketing Management, MSc in Economics and Management, and a Doctor of Philosophy degree in Business and Philosophy degree in Business and Applied Economics. He's a fellow of the Institutes of Chartered Accountants, and the Chartered Institute of Taxation of Nigeria. He's an internationally certified expert in quality system management and business transformation. Professor Onokoya has acquired working experience from the major sector of the economy, including economy, banking, manufacturing, oil and gas services. He is a past secretary to the government of Ogun State and currently lectures economic finance and accounts at Babcock University. Ladies and gentlemen, let's welcome all our guests. It promises to be quite insightful. They have a lot of wealth of knowledge, evidently, and experience to give us insight into today's webinar, the CBN, its policies, and the effect on the wider economy. Right now, I'm going to come to Rotus Odiri, who has an opening presentation for us before we delve into the sessions.
Joanna, thank you. And I don't envy you because Nairametrics has gotten so big, the guests are getting bigger and bigger and bigger, and the profiles are they're just long. We got to do something about the profiles. But I'm happy to be here. And I'm not doing the presentation, actually. That's Ugodre. That's the founder and chief analyst of Nairametrics. And you guys, look, by the way, Ugo has been sharing some incredibly thoughtful and informative information on electricity. You've seen all the headlines on what's been going on in power. Check out his tweets about, issues with, it's very informative. So that just tells you all what Nairametrics is about. Shout out to NMRC deal clinchers. And yes, Ugodre, as always, he sets the stage. He's got these awesome presentations. He lays out the foundation. He sets everything up for the discussion. So, Mayoga, over to you. Let's take us through it. Take us through.
In session, we're just starting. We have a bumper team out here. Of course, the whole idea was that we just wanted to have this whole banking recapitalization and the entire reforms that we are seeing the CBN currently implement and how it affects all of us. Just want to break it down for you. So thanks again to all our panelists and all the participants that have joined. Thank you all so much. We know Saturdays can be very busy for everybody. So, but trust me, this is really going to be an engaging session. Of course, there's always a recording of this that you can always check back anytime that you wish. So I have a short presentation. I'm told I have just 10 minutes. So let me know if you can see my screen. Rotus, can you see my screen?
I can see it. It's beautiful. Nigeria's economic recovery policies. Yes, take it away. It's all yours.
Fantastic. All right. So 10 minutes starts now. All right. Good. So here's my table of contents. I'll just touch a little bit on global forecast and then journey of Nigeria's economic crisis. I'll talk about the key challenges that we're facing. and then deep dive into inflation, exchange rate, budget, economic growth, and then a little bit in the bank on the bank recapitalization. So this is the World Economic Outlook for Global Economic Outlook as detailed by the World Bank and IMF. I'm sure some people may have seen this already, but as you can see, globally, the world is meant to grow at about 3.1% according to the IMF this year. And then we move to the United States, which is typically the bellwether for the global economy. The country is expected to grow at 2.1%. For a large country like this, pretty good, because typically the US have always grown below 2.1%. But over the last few years, we've seen the US compete favorably with the emerging world, emerging markets like Nigeria that has witnessed very low GDP growth rate. And of course, in the euro area, they're still struggling a little bit there. Projection is 0.9% growth. And of course, if you come down to sub-Saharan Africa, where Nigeria belongs, expected growth is around 3.8%. Not enough for countries that you expect should be growing at a faster pace. And of course, if you look at the emerging market, emerging Asia, they seem to be doing a lot better at 5.2% in terms of the projection that the IMF provides for them. And of course, Middle East and Central Asia, 2.9%. Very unsure if they can still hit this number. I'm sure when they send in revised numbers very soon, probably be lower than this because of a lot of the skirmishes going on in the Middle East at the moment. And of course, Latin America and the Caribbeans come in at about 1.9%. So that is for global focus. Now, how did we get here in Nigeria? A lot of people tend to forget how we got here. I mean, the story of Nigeria's economic crisis didn't just start last year, and it didn't just start 2 years ago. You can trace it all the way back to 2014-15, when we started witnessing the start of the oil price crash. And of course, if you all remember, at that time, the exchange rate was around 160 or so to the dollar, 160 naira to the dollar. And then we had the oil price crash, and we had the very first naira devaluation that Ugodre did. I think it went to 197. And then, of course, as we were dealing with all that crisis, the 2015 election came in. And of course, by 2016, all hell let loose. Capital controls came in. We immediately got into a recession. That was also when we had the Brexit votes. And then the militants also now started disrupting crude oil production within the country. And that has basically precipitated into every single thing that we've seen. By 2017, we started seeing a little bit of economic recovery, different kind of policies. We started hearing about banned items, capital controls was in full flow. And that was also the ascendancy of the version of the crypto boom that we're seeing now. All started in 2017. And then, of course, we started seeing a little bit of exchange rate stability when they introduced the I&E window. And then in 2018, the Buhari administration came in with border closure, and then insecurity increased as well. If you all recall, there was a lot of kidnappings, there was a lot of bombings, especially in the Northeast. And then we started seeing a little bit of economic growth as the exchange rate sort of stabilized. And in 2019, because a lot of the exchange rate stabilization that we had then was mostly due to selling Omo bills by the central bank. And the central bank was essentially pushing out high interest rate to attract foreign investor inflow, and we had a bit of stability at that time. And then that was also when we witnessed the very first VAT increase from 5% to 7.5%, if you all recall. So in 2020, as it looked like we're kind of recovering, and then the CBN was also winding down on Omo bills because it was pretty expensive. They have been doing it for about 2 years. COVID-19 struck, and then we all now went down again. And the oil price, of course, crashed, and then you had the end-size crisis, and then the economic recovery started gradually again in 2021. And by that time, it looked like we were already getting into election mode. Inflation now started becoming a concern because we started seeing inflation creep up gradually from 2021. And of course, the exchange rate crisis now boiled over because we have now gone from about 360 that we had for about 3 years, for about 2 years stable, to over 400 and gradually getting to 500. And then people really got tired, and then the jackpot restarted. And so this essentially has been where we are. I'm sure we're all familiar with at least the last 2 years, so I'm not going to delve into it. But very important to understand how we got here, because if you know how we got here, then it's easy to know how we get out of here. And so at Nairametrics, we like to sort of distill the challenges we have in this country into three broader buckets. So the first one is we're in a high inflationary environment where you have high energy prices, driven by high energy prices, currency depreciation, money supply, and of course, insecurity and logistics. So that is basically the challenges around the reasons why we have high inflation. Of course, we also have fiscal crisis where we have budgets that have been largely ineffective in terms of driving economic growth. We have high fiscal deficits, and of course, our public debt is growing, currently over $100 billion. And then with all of this, we're still having tepid economic growth. Like I showed you, we are not growing as fast as we should grow as a country, despite a lot of the money that has been spent. And so there's also lack of ease of doing business for businesses. With crude oil output, we're still doing about 1.314 million barrels per day, when we should be doing about 2 million barrels per day. Government policies weren't really working. And of course, we're also seeing weak manufacturing output. So this essentially is the challenges we have in Nigeria, if you want to sort of summarize them into three. And then what has the government been doing? You have a new government, going to be a year in May, but they've been doing a lot of work just to try and contain the issues and then get us out of here. So on the inflation front, you've seen policy actions from the central bank. This is essentially Nigeria's inflation. You want to break it down. So you can see it's mostly food. Food is the major contributor to inflation in Nigeria. And of course, we're also now seeing core inflation, which is typically what I like to use as the benchmark inflation, also creep up. Core inflation now is at about 24.8%, 24.6%. So typically, lending rates are usually much higher than core inflation. So banks will typically benchmark lending rates at least 5% higher than core inflation rate. So this is essentially where we are in terms of inflation. Of course, food inflation, we're gradually hitting 40%. So what has the CBN been doing? Increase MPR to 24.75%. They've also increasing MPR twice already. In fact, MPR has been increased since last year. Emefiele started the increase, and then Cardoso has continued with increasing MPR just to contain inflation. Of course, CRR now 45% and liquidity ratio 30%. They've been mopping up money supply in the economy by issuing out treasury bills and OMO bills. They've also stopped ways and means borrowing, which a lot of people like myself believe contributed to the increase in money supply in the country. So that is now being curbed. And of course, there's a lot of social safety nets out there just to help pushing the effect of a lot of the policies that the government is pushing out. And of course, there's also a lot of supply side initiatives that the government is also putting forward just to sort of help things. So such as, of course, roads and trying to curb insecurity, a lot of efforts around the technology space, which I will address as we move on. Now, exchange rate, the big elephant in the room, because a lot of people believe this is one of the reasons why we also have high inflation rate. As you can see, this chart here, it gives you the trajectory of Nigeria's inflation rate. This is the official rate, by the way, in green here, as you can see how we've been going. In fact, at some point in February, if you all recall, we're hitting 1.6 plus. And of course, on the parallel market, it got to as high as 1.8, almost hitting 1.9. But over the last few weeks, we've seen the Naira fight back with all vigor. Naira is fighting back. So gradually dipping to below 1.3. This was as of March. So we're in April already. We're seeing it at about 1.250, likely going to fall even further as we go on. So what has the government been doing? They divide the exchange rate. They introduced, sort of reintroduced NAFED. They brought back the BDCs. In fact, there's been a lot of reforms in the BDCs aspect segment. If you all recall, they even canceled. I hope you guys can still hear me, Rotus. Hope you can still hear me.
Yes.
Loud and clear, loud and clear.
Oh, fantastic, fantastic. All right, so we've seen the introduction of BDCs, and of course, they've canceled a lot of licenses, so all those very funny BDC names that we heard. So those guys are out of the window. We've also moved to a more market-determined exchange rate, even though the CBN will tell you, look, it's not a free full float, but it looks like a semblance of a free float, where you're now seeing the official exchange rate even weaker than the black market rate. Of course, we've seen new guidelines for IMTUs. We've seen the removal of FX caps, clamp down on Binance, which I actually think is one of the major reasons why you're seeing the exchange rate stabilize. That essentially just shut out a window of trading exchange rate that often plays with the exchange rate itself. So that window has been shut. So no more benchmark of Binance as determinant of exchange rate in the parallel market. So this has now been off. And of course, you've seen a lot of increase in interest rates for T-bills and automobiles. This essentially has sucked out Naira from the economy. And when you suck out Naira from the economy, there's not enough money to buy dollars. So speculators take heat. That's what typically happens. It's been expensive, like we said, costing a lot of money because you have to pay high interest rate for this. So as much as this is also fighting inflation, it is ultimately meant to bring down the weakening Naira, to strengthen the exchange rate. And of course, there's also been a lot of payment or FX backlogs to airlines and all that. So you've seen a lot of all this happening, and you're already seeing the effect. You can't deny it, even if you are not in support of the CBN policies. It seems to be working. As you can see, this chart proves that. And so what else in terms of the fiscal side? This is where I actually think Nigeria has a lot of problems. As you can see with this chart here, by the way, you can get all these beautiful charts on analytics.com. Let's go there. It's a Nairametrics website, so that's where we have a lot of all these charts. So if you can see, as you see, over the last, 6 to 7, 8 years, we've seen that on the fiscal policy front, we've been spending more than we earn. So as you can see, from 2020, I think this thing all started around 2016, 2017. As you can see, recurrent expenditure way higher than revenue. And if you add non-debt recurrent, if you add debt and then you add capital expenditure, you see that we've been spending more than we have. And so we've been incurring huge fiscal deficit. And go and ask any economist, where you have huge fiscal deficits, it tends to deliver exchange rate weakness. So your exchange rate tends to suffer at some point. And this is what has been going on. This is up to 2022. You can see here, 5 trillion versus almost 17 trillion. So the gap is huge. And even in 2023, we're already seeing that there's a deficit financing of over 9 trillion naira, and it could even get higher than that. And so this, I think, is a huge problem that the government needs to sort out. And this is essentially the 2023 budget. As you can see, there's a lot of deficit spending here. The government is looking to borrow 8.2 trillion just to plug the deficit hole. And this is if it is even able to raise the entire amount of money that it hopes to use to fund the 2023 budget. But what has the government been doing since to also sort out the fiscal side? It's not like they haven't been working. We've seen the removal of fuel and electricity. Just recently, electricity subsidy, that has been a huge drain pipe for the government. So they've essentially taken that out. We've seen them end intervention funds as well. That is also where they tend to always increase their borrowing. And so they've stopped that. There's a lot of tax reforms being implemented by the Taiwo reform panel. We've seen a lot of work that they're doing. So reforms going on in there. It's huge revenue mobilization. I'm sure every day you see in the news how much custom is raking in, how much FIRS is raking in. These guys are under immense target to raise revenue. And you've also seen gradual implementation of the Oron, and the government has now decided to do something about it, even though it's not as aggressive as we think, but at least there's a lot of work going on in that direction. So you've seen a lot of work there. The increase in crude oil output gradually going up, especially now that crude oil prices is hitting $90. So maybe government revenue is going to stay on. And guess what, guys? Once you start to see crude oil hit $90+ and we see our output increase, trust me, the exchange rate would be stable. There's just certain things that determine how your exchange rate moves, regardless of what happens. So these are very good signs. So if you're a speculator out there, man, you gotta be worried, because with crude oil output going up and the crude oil prices going up, that it means that Nigeria's external reserves would likely continue to increase. Of course, you've seen a lot of reforms as well. A lot of people call it audio. Looks like audio, but solid mineral sector reforms. We don't know whether it's going to yield any fruit, but that's what's going on. That's what they are doing, at least. A lot of bilateral cooperations. We've seen Nigerian government traveling left, right, center to the Middle East, to China, to US, all trying to look for some kind of bilateral cooperation that will see foreign investment move into the country. And of course, we're seeing gradually, not as much as a lot of us would want, but better coordination between the monetary policy, between the monetary and the fiscal side of the government. Remember, Cardoso said it, that no matter what he's doing, he needs the fiscal side to also step up. So we're seeing a little bit of that. It's just last 2 weeks that they set up a panel that include the private sector. So I guess those guys are getting to work. So we hope to see a lot more on the fiscal side. Now, in terms of Nigeria's GDP, oh my God, looks like I've gone past 10 minutes. In terms of Nigeria's GDP, a lot of work going here. As you can see, this is our GDP numbers. The government wants us to hit 1 quadrillion naira, because, I mean, if you use 1,000 naira to dollar, that's essentially what it is. So one trillion in GDP. We're currently at 225 or so trillion naira in terms of GDP. So it's going to take a lot of work to get there. But one question for everybody: if this exchange rate was 220 to the dollar, wouldn't we have been at $1 trillion already? It's always something that just pops in my mind. But anyway, let's go on. So in terms of policy actions, monetary policy reforms, you've seen a lot of that. It's seen a lot of efforts to attract foreign investors. They are continuing the Buhari administration's agri-sector reforms, albeit in a different form. We're seeing a lot of diversification away from crude oil audio because we're not really seeing the full action in place. We still rely a lot on crude oil here in Nigeria. They're trying to harness with crude oil sector reforms. We've seen implementation of AFCA a little bit slow, but I think these are some of the things that they require to drive Nigeria's GDP forward. Infrastructure and construction projects, I think this is going to be one huge area that you see economic growth come from. And of course, there's a lot of IT initiatives, whether it's a natural AI strategy or 3MTT, cloud computing. These are all efforts, drawn towards pushing the economy forward. And you also see a lot of focus on local manufacturing and, of course, lastly, banking sector reforms that the government, not just the central bank, believes should be the key driver of Nigeria attaining the $1 trillion economy that we want. Now, this is just a little bit of an idea of what Nigerian economy has, what our GDP has looked like over 3 essential periods. So this is 2016, this is 2022, and this is 2023. And as you can see, in 2016, trade was like the number one, the largest sector in the economy. But trade has been toppled by crop production ever since. So crop production is now 42. So it's gone from 18 to 42. Now, why do you think that is happening? That is also because of a lot of the focus of the government. So when government focuses a lot on one sector, you tend to see that sector grow. And so you've seen crop production sort of doubled and is the largest in the economy after 2020. Even after 2023, you're seeing at 47. Trade still growing, but not as huge as crop production. Nigeria is basically a service-based economy. And then you've seen telcos. Telcos used to be 8.5 trillion. Telco just recently toppled construction at 25.2 trillion. So you can see tech is huge in terms of how Nigerian economy is growing. And then construction, which is also another sector that has seen huge growth at 22.1 trillion. So look at all of this and ask yourself, which sectors do you think is going to lead Nigeria in the next 5 years? Which ones are going to be the top 5 or top 10? My bet, looking at education, I think education is going to be a huge mover. Cement is going to be a huge mover. Financial institutions with this bank recapitalization going on is going to be a huge mover. You want to check out that sector. Electricity sector as well, likely going to be a huge mover. And so these are the sectors that I think are going to see huge growth over the last few years. I mean, think about it. Look at education, just 3.1 trillion in terms of size. You think that this would also grow. So this is Nigeria, and you can see things change. See how it was. Cement was just 20 after 2016 at just less than 700 billion. But look at where cement is today at 7 trillion in less than 10 years. So these things do happen, and expect to see a different composition of Nigeria's GDP in the next 10 years. So now we're quickly now going to bank recapitalization, which our panelists are going to speak on at some point. We all see the objective of the bank recapitalization, as the central bank governor has spelled out, said it's to engender the emergence of a stronger, healthier, more resilient banks to support the achievement of the 1 trillion economy. So you can see that is why they want to raise this money. That's what they claim. But if you now look carefully and see why now, it sort of gives you the real reason. You see, they said is to further strengthen Nigerian banks against external and domestic shocks, as well as enhance the stability of the financial system. That sort of makes you understand that some banks are not really strong like that. They're not really strong. So the CBN really needs banks to recapitalize so that when they release the forbearance, they can absorb a lot of the losses that are coming. That is what a lot of us think is also the major driver for all of this. And that is why there is no retained earnings in the calculation or the composition of what the central bank calls the share capital. And a lot of banks don't like it. I'm sure the panelists will delve into that at some point. So in terms of how much banks need to raise, I think a lot of you have seen this table before. This is just a larger table. We included a lot of banks here, so you can all have an idea of how much minimum 4.3 trillion is going to be raised. This is essentially going to change the Nigerian economy over the next 1 year or two with a lot of activities. Trust me, it Nigeria can raise this amount of money, you can't imagine the economic activity this is going to create. Whether you like it or not, there's going to be business for a lot of people. So this is one to look out for. And so what are we going to expect? What to expect is Nigeria going to be able to address the root cause of our challenges, the three buckets I mentioned? That's what we need to know. Is inflation going to drop to 25% by the end of the year? I don't know. I guess the panelists would also discuss it at some point. What about money supply? Is it going to keep growing because it's gradually hitting 100 trillion? Are we going to see it at 25% of GDP, which is typically the acceptable number? No. Of course, what growth areas is the government looking at? Is it going to be health? Is it going to be sports and entertainment? Of course, what sort of progress are we seeing on the technological front? You're seeing the Minister of Tech, making a lot of noise and doing a lot of work in terms of trying to push the tech narrative in the country. Let's see how that pans out. And of course, how would access to the capital markets be simplified? We do believe in nairametrics that no matter what the government is doing, the capital market needs to be the agent of economic growth. If a lot of all this money is not going into or passing through the capital market, we're not going to reap from the benefits of it. So we strongly think that the federal government should make sure that all the companies and all the organizations that are going to be integral to its economic growth plan should have some form of listing in the capital market. So Rotus, that is my presentation, and I hope that this will set the tone for the discussion that is about to start. Thank you all very much. I know I've gone past 10 minutes, but indulge me, please. Thank you so much.
Ugodre, look, I love your presentations. They always set the tone for our discussion. Thank you so much. And again, as Ugo spoke, Nairalytics, so www.nairalytics, Lytics, nairalytics.com, treasure trove of data there. Ugo, thank you so much. So let's get into it, right? Let's begin, of course, with notable CBN policies and the potential areas of impact. So over the last 10 months between June of 2023 and March of 2024, have I introduced myself? Rotus Odiri, Arise News. All right, so between the 10-month period, the central bank has issued over 100 notifications, right? And people like applauding Ugodre, by the way. Yeah, put your comments there. He deserves applause. He does. That was a very exactly. Ugodre, they're shouting you out there for the presentation. So over the last 10 months, between June of 2023 and March of 2024, the central bank has issued over 100 notifications, which includes 50 circulars. If you average that out, 5 circulars a month, right? Which has led people to call them CBN Circular Bank of Nigeria, which is pretty funny. 30 of those circulars have been issued in the last 4 months or so, between December and April. So the question, of course, being, what's the CBN trying to achieve? Is this overkill, or are they hitting the nail on the head? Let's begin with Dr. Biodo Adeleke. Dr. Biodo, I don't know if you can pick your top 3 of those circulars as to which are the most important that jumped out to you and why. The floor is yours, sir.
Thank you so very much, Rotus. My top 3 of all of the circulars and the policies rolled out by CBN will be: number 1, the decisions of the Monetary Policy Committee with respect to the MPR, and of course the reserve requirements for our deposit money banks. Now, as Ugo mentioned in his presentation, twice the MPR had been moved, and that is cumulative 600 basis points, and that is quite significant. And of course, having its implications in terms of targeting inflation, and also at the same time, creating an environment for Naira to find strength and begin to challenge the US dollar, major trading currency, so to say. Now, the second one for me is the revocation of the licenses of 4,173 Brody change. And that, of course, is coming from 2 perspectives. The first is the fact that we look at the last, that should be like 12, 13 years, when leadership of central bank granted licenses in an aggressive manner that took the number to where we saw over 6,000. Okay. Now, taking that number out was first, and then also Along with that is introduction of transparency in that particular segment of the FX market. And that means every transaction now will include information about the buyer, especially the BVN. All right. Now, with the BVN, it means it will be difficult to game that system. And so that brought some kind of sanity into that segment. And that is very, very important in terms of, creating this sense that we are clear about where most of these problems are coming from and also addressing them. My third, top 3 CBN circulars will be the one relating to extinguishing the matured foreign obligations. And especially for me, that came as a very strong signal, on the one hand, to all the stakeholders, especially external of Nigeria, that if you, for example, are a foreign investor, you come in here, you know that for sure, going forward, there is the free capital flows that will enable you to take out your money. That's one. 2 is the fact that, yes, the current management, we inherited some obligations from 2 major perspectives, as mentioned by Ugo in his presentation. There are the FX forwards and, of course, also some transactions involving foreign airlines. The other side to it is the one that they have not said anything about, and that is borrowings made by central bank using our external reserves as cash collateral, of course, to 2 of the major, global financial institutions. Now, having done that for me also was a strong signal that Nigeria is ready for business and, of course, free flow of capital. So those are my top 3 among the plethora of several, as you mentioned, circulars that were rolled out by the CBN in the last couple of months. Thank you.
Thank you so much, Dr. Abiodun. Thanks for talking about the NPR. Thanks for talking about the BDCs, bringing some more transparency to that. Let me quickly jump to Professor Onakoya. Professor, from the perspective of our audience that are trying to figure out, how all this comes together and I guess impacts them. Professor, how would you say these circulars measure up to the central bank's core mandates, price stability and the likes? How do you see it?
Yeah, thank you very much. You see, the principal object of the CBN, as provided for in the second section of the Act as amended, are clearly 5. To ensure monetary and price stability, CBN to issue legal tender currency in Nigeria, which says Naira is legal tender. To maintain external reserves for the purpose, again, for the purpose of safeguarding the international value of the Naira. 4, to promote sound financial system in Nigeria, and finally act as banker, 1A, and provide economic and financial advice to the federal government. It is in consonance with that this plethora of circulars have been brought to the fore. But essentially, the CBN, under this new management, in January 24th this year, the governor, Dr. Cardoso, brought out the 5-year CBN strategy, 2024 to 2028, which are essentially, again, to address major theme, the essential principal object of the bank. So the bank is talking about preserving domestic macroeconomic and financial stability. Is ensuring price stability, robust and resilient financial system, talking about its governance, compliance, and being, again, the advisor to government. So it is in pursuance to this objective as contained in the second section of the Act, consistent with the 5-year CBN strategy 2024-28, that all these circulars have been pushed out. The essence of the circulars is essentially to uphold the integrity of financial markets. And this is considered to be crucial for building confidence And it's also to serve as catalyst for inclusive growth and sustainable economic development. I will highlight just maybe 5 or 6 of the CBN circulars in one of the sectors. We're looking at one of the major functions, ensuring the strength of the local currency. January 29th, the circular to authorize dealers of financial market price transparency. Dr. Adedekwe alluded to that. In January, letter to banks on harmonization of reporting and the requirements of foreign currencies, again, bringing transparency into the foreign currency market. So at least we know what we are owing. Essentially, the directive has spot increased activity in the Nigerian Autonomous Foreign Exchange Market, NAFEM. We now see daily turnover over and above about $854 million, almost 4 times increase. Again, consistent with this strengthening of the Naira is the January 31st circular, which reviewed the guidelines of international money transfer services to Nigeria. And the removal of the allowable limits of exchange rates quoted on the international money transfer operator, which is another circular that came on the 31st of January. All these are aimed at ensuring, strengthening the muscle of the Naira. In February 8th, we have the removal of spread on foreign exchange transactions. And on the 26th of February, we have the mandatory reporting of foreign exchange transactions. So you can see in this area alone, all the circulars were aimed at cleaning up the markets. In some areas, they found they didn't get it enough. Once they get this circular, it's not achieving the objective, they now adjust and adjust. But the good thing is that the CBN appears to be on track with respect to the foreign exchange market. But of course, we know that it takes more than the CBN and monetary policies to ensure Naira stability or the strengthening of the Naira. It takes a lot more. There is the fiscal policy aspect, the supply side, which will be a matter for discussion further in this webinar. Thank you.
Thank you so much, Professor Onakwe. Let me quickly come to Dr. Bumi Bajimo. Dr. Bumi, from the perspective of investors, what do you think they will be excited about? Because, again, to shout out the great reporting from Nairametrics, I was reading an article in Nairametrics, it was either yesterday or the day before. In fact, I made it an entire segment on my business program on Arise News. The interest payments that the CBN has been making, well, at least what was calculated for Q1 of this year, I think Nairametrics said it's about 1 trillion naira. That's for NTBs, the treasury bills. So investors, it looks like FPIs have been enjoying those juicy interest rates. So that I say that to ask you, Dr. Obajimo, what do you think, how investors would view what the CBN has put forward in these circulars and whether they'll like that or not? The floor is yours.
Thank you very much, Rotus. Good morning, everyone, again. I think from an investor's perspective, 2 major policies that would interest the investing community, or in my view, which interested the investing community most, was number 1, the MPs, besides the flotation of the currency via the January 29 circular, will be the MPC decision to increase policy rates by 400 bips and then additional 200 bips to 24.75. Then the second will be the MPC decision that increase the cash reserve requirement from 32.5 to 45%, making Nigeria effectively the country with the highest CRR globally at the moment. 2 positive signals from this is that number 1, the increase of cash reserve requirement actually sucked in about 1 trillion naira from the economy from the moment of implementation. And then the adjustment of interest rates on the back of the MPR increases signal to the investing community that the central bank was now ready to increase the level of interest rate. Mind you, the negative interest rate differential or the negative interest rates had been the bane of all of the previous circulars, all of the policy initiatives. Because looking at it and comparing ourselves with the rest of the world or even our immediate neighbors across West Africa, no serious investment would come in an environment of significant negative yield. What the MPR adjustment has done is to narrow significantly the negative yield that had been prevalent. Now you have an MPR rate of 24, right, 0.75. So close to the level of core inflation at 25.15. That narrows the share. What that does is it allows the investment community to rethink their policy around Nigeria, and it makes a compelling case for them to revisit investment in Nigeria. It is thus not surprising that you've seen that between January and February, the total investment flows, call them FPI, was 2.3 billion, which compared to what the total sum of 3.9 billion that the nation achieved last year is actually quite significant. What happened hitherto was that the flotation of the currency was not immediately backed by necessary indicators, which was why we had significant volatility in the economy. But with that out the window, we can see positive vibes. We can see it reflected in the level of exchange rate, as Ugo has talked about. So from where I see it, every action has a consequence or has consequences. All of this initiative will not be an exception. There might be collateral damage in the SME space owing to the contending issue of significant borrowing cost, added to significant exchange rate devaluation, depreciation, as you might want to call it. But on balance, the direction of travel is positive. We would expect from all of this action that inflation will begin to moderate. It will remain elevated in the short term through the rest of first half, but going forward, the combination of exchange rate appreciation combined with all of the fiscal issues that Ugo has talked about should lead to moderation. Money supply will remain a clog, but given the CRR increases effectively and then the adjustment to liquidity ratio, it should actually begin to moderate. Let me stop there. In terms of loanable funds, the combination of 45% CRR and 30% liquidity ratio effectively means that over 70% of loanable funds have been quarantined. That will constrict output, but it would address to a reasonable extent the issue of money supply. Though I have my views around the money supply issues, if from the NDIC report as widely reported, over 173 million current accounts open in Nigeria. If 97.3% of them comprises of balances below 500,000, 97.3 qualify for NDIC insurance premium. How come the money supply is so high? Is it because the balance, $4.something million, controls the economy? We need to dimension that. Thank you.
Dr. Bumi, that is a very pertinent point that you raised and a very good analysis of that question with respect to those balances and what that means for money supply. Thank you so much for that. That brings us to the end of session 1 on the notable CBN policies and the potential areas of impact. Now we go to session 2 on the core objectives, price stability, and so on and so forth. And as has already been mentioned, Dr. Bumi just talked about money supply, which as of February was, or rather February of this year, I think 93 trillion. Going back to, I guess, June of the prior year, was about 64, so that continues to rise. Although CRR has been hiked, so we'll see how that impacts things. Inflation still rising. We had what, 31.7 headline as of what, June last year was 22.7 or so. So these things continue to move despite the moves of the central bank. Now, of course, I think folks will probably say MPC just met. They've made these decisions. We need to see how they come through. But with session 2 now, we want to talk about those core objectives. Let me bring in Praise. Praise, your surname is awesome. Ihasekian, I think I got that right. Head of Investment and Research at Meristem Securities. Praise, we're now session 2, core mandate now of the CBN. What else do you want to see, Praise, with respect to what the CBN is doing in order for the core mandate to be fleshed out and the impact to be felt by Nigerians everywhere? Praise.
Thank you very much, Rotus. I would say that a lot of the points have actually been succinctly addressed by the other panelists. And the truth is that the CBN has been very busy. Like you mentioned, so many circulars, about 50 that we've seen so far this year. And the CBN has, brought a lot of arsenals that they have in their books. At this point, there really is little to no wiggle room for the CBN to move anymore in terms of maybe implementing macroeconomic tools that can help them fight inflation. The CBN is, the expectation is that the CBN continues to float OMO bills, because these OMO bills are very instrumental in determining the fixed income environment and what the fixed income rates would be. And we know that this also translates into what Ugo was talking about, the fact that the interest rate is now very attractive for Naira investments. So the incentive to go invest in USD has been significantly reduced by the CBN for increasing the monetary policy rates, issuing out OMO bills, and all the works. Some of the other panelists have also mentioned, the fiscal policy has to really step in at this point. The CBN can, however, also explore multilateral lending in terms of having some bilateral concessions with other central banks. And then, of course, I think another thing that we can explore as a country is to have other arrangements with other countries to pay for whatever it is that we are importing in a different currency and not just USD, to just reduce the demand for USD. But the CBN can definitely explore, speaking to and having, bilateral agreements with other central banks that would see that significant inflow of dollars coming into the country. If we have a significant inflow of like about $10 billion just coming right now, that comes with maybe an extended tenure of agreement, or something like that, it would be very, very instrumental. And so we need to see those inflows coming. We've seen the portfolio investments increase, which is very good. Foreign portfolio investments have increased, and of course, we've still not gotten to where we were before 2020, but we've seen that increase happen so far this year, which is very good. But we need to see more of foreign direct investments coming. And for those foreign direct investments to come in, they will not come in if the economy is not stable, if the economy is not, if they are not seeing good economic environment, good macroeconomic points that can, ensure stability of returns. So the CBN has actually done a lot. I think we've all agreed, even from Ugo to every other panelist on this call, we've all agreed that the CBN has been very instrumental in all the policies that they've done so far. So there really is, they've played a lot of arsenals in their books. For now, they need to, be able to sit back and enjoy the fruits of the labor, but significantly, they need the backing of the fiscal policy to, wake up and also support their actions.
Thank you. Thanks for being quick with your answer, because we're kind of running behind on time. So we have to have our panelists give us some quick fire answers. All right, Praise, appreciate that. Dr. Biodun Adebikwe, let me come back to you. As far as the real economy is concerned, you heard Ugodre at the tail end of his presentation talking about the sectors he thinks are going to benefit in the future. He mentioned education, for instance. What about you, Dr. Adebikwe? What sectors do you think, as far as the real economy, are poised to benefit, from any particular tailwinds, from what we've been discussing?
Okay, thank you very much. I will pick manufacturing first, and it's for the good reason that manufacturing thrives when the exchange value of Naira is stable. In which case, a stable Naira enables manufacturers to plan. And of course, it means that if the rate is also stabilized at what we generally expect between 1,150 to 1,250, then there's a possibility then for manufacturers to be able to plan. So I expect a lot of traction in manufacturing. But that also is just by the way. The real facts out there is clearly we see a lot of new manufacturing entities setting up factories, in some locations within Nigeria, especially in the Southwest. And it is quite interesting. So we expect more of this to happen. And a good number of them also are coming from China and, of course, Eastern Europe. I will leave it at that. Secondly, I expect trade to also be a beneficiary of that. Number one, being the third largest contributor to our GDP, and of course, remaining very strong in contending with agriculture and ICT. Between those three, they've been the largest contributor to our economy in the last 12 solid years, back to back. So now trade remains important because of our consumption habit of Nigerians, high import content of what we consume. That is unlikely to change overnight. And so it means then that as the exchange value of the Naira stabilizes, then we see a pickup again of demand for non-oil goods and services. My third sector is a cross between ICT and fintech. This again is coming from what we know as inquiries from investors. Nearly, I would say, for my own firm, on a weekly basis, we receive inquiries from foreign investors that are looking especially to the fintech space, and of course, looking at peculiarities of the Nigerian economy, going more and more digital, and of course, a population that is useful and also rapidly urbanizing, again, has implications for the ICT sector. So take all of this together, and the demand for data grows as well. That creates opportunities for investment within the ICT ecosystem. So I put this as top three. Then I also will align with what Ugo said on education. And if you see the data with respect to what is happening, for example, in the UK, where there are about 15 universities now that are threatened in terms of their sustainability because of the exchange value of the Naira that makes it impossible for students enrolling with them from Nigeria. And of course, a couple of other countries, but Nigeria is top of the bill. So what that tells you is that a flashback, let me see, to education in Nigeria. And of course, investors coming also in that space. We know quite a number of new universities are springing up in Nigeria, not only focusing on students from Nigeria, but from other countries as well. That is to reverse and take us back to where we were. In the days we had many foreign students in our universities locally. So I will add education to those top three in my own estimation. Thank you.
Thank you so much, Dr. Didikwe. So manufacturing, trade, ICT, and then you added honorable mention to education. So Dr. Bumi, I actually wanted to zero in further on trade with respect to asking you how players in that sector can position themselves to take advantage of what's to come. Because, I mean, folks, Dr. Adedikwe just talked about stability, but I mean, exchange rate is still higher now than where it was when the big devaluation took place last year. So, and then of course we've had customs, and Nairametrics has been reporting this often. Customs switching the exchange rate for what as far as bringing goods into the country. Then you've got the borders and all those other things. So, Dr. Bumi, from your perspective, how can folks in trade position themselves?
Thank you, Rotus. So I think I agree with you that the CBN has actually been quite proactive in their core mandate, which I will christen the SC, which is the maintaining the soundness, stability, enhancing efficiency of banking, and enhancing banks' competitiveness. So how does this now impact the core stakeholders, key stakeholders to be? Number one, the banks, then the manufacturers, the traders, the major operators in the real sector. You have the correspondent banks, and then you have the central bank, which is the ultimate regulator of banking. So in terms of the benefits of all of these initiatives to the operators, first, from the bank's perspective, current momentum allows, number one, for orderly settlement of customers' obligation. It eliminates the issue of default on matured obligation, which actually had given a number of financial institutions negative ratings and negative pricing structure with their correspondent bank, owing to the fact that they had a lot of matured obligations which were not settled properly, and then that has implication for increased pricing on those trade obligations. Secondly, when the banks are not able to settle obligation properly, it impacts on their ability to even lend further to the trade segment of the economy. It constricts the level of letters of credit that can be issued, and as a consequence, the volume of international trade. It also affects their cross-border pedigree, because from the moment the shipment takes place and the post-shipment financing kicks in, it becomes a direct hit. It's no longer contingent on their balance sheet. So having an orderly settlement of trade obligation, having access to foreign exchange helps the bank to improve their competitiveness, and then ultimately it will improve their net profitability in terms of the net interest income and even the non-interest-based income in terms of fees and charges, which ultimately will improve the gross earnings of the financial institution. For the real sector, one issue that has bedeviled the economy has been the issue of trapped funds, owing to the fact that a lot of real sector players had to back up their foreign trade with Naira equivalent in the absence of an effective settlement mechanism for their trade exposures. What would happen is that right now in this market, pricing may be an issue. It depends on the level at which you want to buy your FX. From what I have seen in the past week, everyone who needs to buy FX can get their FX. That is an outstanding achievement for the central bank and every operator in this market. So what that does to the customer is that at least now they can effectively plan forward. They can effectively determine their cash cycle. They can effectively demand what their cash conversion cycle will be like and be able to price their products effectively. So whereas they take it in terms of the devaluation of the Naira, it's mitigated by the fact that they can now have accelerated trade cycle. In addition to that, they can also now expand their capacity. What you've seen in the past 1-2 years is that a lot of companies have been operating at sub capacity level, or in fact, less than 1/4 of their capacity, because they couldn't get the raw material. And that felt into the cost push inflation that we've talked about. So ability to source FX, ability to process their trade timely, ability to process their ordering would also ultimately impact on the level of inflation. It will impact on their pricing. So for companies like the consumer segment, where you've seen astronomical increases in the price of food and commodities, you will begin to see a moderation. To the correspondent bank, a lot of correspondent banks have become so agitated about exposure to the Nigerian banking economy on the back of the fact that the date of maturity cannot be determined. You've had correspondent banks that have weathered this storm for upward of 2 years with the Nigerian economy. It takes a lot of understanding to bet on this economy, to remain true to the economy. If you've had those kind of situations, those correspondent banks who have had to explain over and over to the rating agency, to their management committee, can now begin to breathe a breather. That is rating positive for the Nigerian economy. It's also rating positive even for the Nigerian banks in financial intermediation also acting as correspondent bank to other smaller banks in Nigeria. Then in terms of the central bank, the first benefit to the central bank is improved transaction flow. So the level of money supply multiplied by velocity is the same as the price level multiplied into the number of transactions. So that level of transaction flow, because there would be better volatility of transaction, then you expect accelerated growth in the volume of transaction. That ultimately will lead to a growth in output, which would also now feed into the GDP of the economy. The CBN also will have better oversight on banking operation. Somebody talked about forbearance and all of those things. Those forbearances, if they are present, have been due to the fact that a lot of these macro issues have impacted customers' ability to settle, and then, it just necessitated some kind of grace and forbearances. All of those, CBN can have better oversight of financing pattern, cycles of trade, and then there would be a reduction in default risk, because if you can't settle your trade effectively, it's a default. There will be, and then those will lead to price stability. So I think those are some of the benefits. So in terms of current momentum, is actually positive for operators in the trade segment. Thank you.
All right, thank you so much for that, Dr. Bumi, for breaking that down for us. So much is happening, so many innovations and evolutions, and we'll be following all of that. Our panelists are doing an awesome job. And remember, if you do have a question to ask, feel free to drop in the Q&A section. We should be heading there in a bit. But we have to also recognize our headline sponsors, the Nigerian Mortgage Refinance Company, who are on a mission to break down barriers to home ownership by providing liquidity, affordability, accessibility, and stability to housing markets in Nigeria. A quick message from them before we head into the third session. All right, while we work out the sound, just some insight into, the NMRC, right? It's a private sector driven mortgage liquidity facility with the public purpose of promoting home ownership for Nigerians. We know it's quite a deal right now, and they're also working on deepening the primary and secondary mortgage market. It was incorporated in 2013, and it's obtained its final operating license from the Central Bank of Nigeria on 18th February 2015. They're involved in so much, right? They've worked with key industry stakeholders like the CBN, the Mortgage Bankers Association of Nigeria, the Federal Mortgage Bank of Nigeria, and the Nigerian Deposit Issuance Corporation to develop and streamline mortgage underwriting standards to widen the net of potential borrowers and also enhance financial inclusion. So it's a great work that NMRC are doing, and so many achievements as well when it comes to successful advocacy with state governments on the passage of modeling mortgage and foreclosure laws. They've worked with the likes of Kogi State, Cross River, Kaduna, Ogun State, to mention a few. Interesting is also their use of technology to integrate a fractured housing market. Other innovative market development initiative, they've tapped into the blockchain technology capacity, right? For tamper-proof record keeping, and they're building a robust national asset registry system for driving real estate transactions. So once again, we recognize our headline sponsors, NMRC, To get more info, of course, you can head to their website, www.nmrc.com.ng. And they're also, I believe, across social media, NMRC, Nigeria Mortgage Refinance Company. So a huge shout out to them. I'm handing the mic back to Rotus Odiri as we delve into the third session. And remember, keep your Q and questions coming through. Drop them in the Q&A box. All right, Rotus, over to you.
Thank you so much, Joanna. Shout outs to the sponsors, NMRC and Deal Clincher. I think I even saw someone from Deal Clinchers in the comment section. So I think one of the sponsors is what I think his name is Israel. I think, yeah, somebody from one of the sponsors is here. All right, so this has been very informative. We're going now. Session 1 was on the policies from the CBN, potential areas of impact. Session 2, core objectives. Now session 3, the financial system, and Ugodre touched on it in his awesome presentation where he talked about the minimum capital requirements, how that has been revised upwards, whether or not the banks can meet up, and what that means for us. So let me come back to Professor Onakoya. Professor Onakoya, I want to start with you on this recapitalization. Just for those who are wondering why this move, Professor, was necessary. Can you speak to that?
Yes, thank you, Rotus. The new CBN minimum capital requirement circular is akin to what Professor Soludo did in the past, that reduced the number of banks in Nigeria to about 22. From over 60. With the same play game happen this time around, we're yet to see. This is because the minimum capital requirement has been moved 10 times for the international banks. Commercial national banks, about 4 times. For non-interest banks that are regional, about 100% increase. But the catch is this: the eligible capital is only the paid-up capital and share premium. It excludes the retained earnings. It excludes other Tier 1 capital, terms of capital reserves and preferred stocks. What it means is that all the banks are currently short of this new threshold, but requiring at least about 4 trillion capital to be raised either from the stock market or from mergers and acquisition or from right issues or private placement. In effect, more money must go into the banks. There are implications. But before then, there seems to be a divergence with the requirements for the capital adequacy ratio, CAR, that for international banks is 15%, and for other banks, 10%. The capital adequacy ratio does not discriminate in the form of internal capital. It accepts paid-up capital. It accepts retained earnings. This is the same thing as required by Basel III. And then the question is, if we allow retained earnings to be part of eligible capital in the capital adequacy ratio, and we do not allow that in the current minimum capital requirement, there seems to be some contradiction there. But I trust the CBN with its plethora of circulars. Should expect a circular that will harmonize this position very soon. But again, some other countries, some other jurisdictions, retained earnings is allowed, but they are also subject to some conditionalities. For example, we can be limited to a particular maximum percentage. It can be subject to additional regulatory approval. It can be subject to additional risk-based adjustments. It can be subject to additional auditing, so that the banks or the smart Alex in banks do not use this loophole to forge out capital in terms of paper, like they happened during the Soludo era. What the current capital requirement increase, it requires additional cash to come in. And that comes in, that's a very good thing, because we expect to now have stronger banks with stronger, bigger base. It also should lead to enhanced capital market activity. If you are going to have private placements, you are going to have listing on the stock, additional listing on the stock exchange. It also lead to increased foreign direct investments if you are sourcing these funds from abroad, in which case more dollar comes to the system. But the question is, will it lead to cheaper business loan thereafter? But one thing is clear, the issue of crowding out of the real sector in the capital market. Because if the bank stocks are more attractive, the real sector may not be able to raise additional funding from the capital market. But importantly also, at the end of the new capital requirements being met, you may have watered down valuations. The earning per share that might become issue because the base for generating the income has become much bigger. Because of some very messy last-minute mergers and acquisition, like it happened again in 2004 during the Soludo era. Furthermore, you can have hot money coming into the system. Could it lead to money laundering? So the FCC will need to be on the lookout. Essentially, it's a good thing to have this capital requirement being the minimum requirement being increased. It's essentially good for the economy to have stronger banks that are more robust, that are less likely to be subject to the debilitating effects of the Naira that appears to have crashed. Thank you.
Thank you very much, Professor Nako. And that was a very good point that you raised about the retained earnings. You're allowing it in the capital adequacy ratios for the banks, but you're not allowing it in these revised minimum capital requirements. And you saw Ugodre when he was doing his presentation, he was like, some of these banks, and we won't get into all that. We'll get some more clarity, right? Maybe as the professor said with another circular again. Praise, Ihaseki, let me bring you in here. Does this mean, Praise, that both the private sector and the public sector should anticipate increased availability of credit? Can I get a loan, a better loan from the NMRC and deal clinchers so I can get a big house with a home gym and my kids running in the backyard and the dog and all that? What Praise, what does this mean? Can we get a better credit with this minimum capital requirement rate?
I like the picture you paint. I like the picture you paint, Retos. You have a good point with the question. When basically increasing the capital requirement for banks is increasing the base that they can, increasing their lending power over the long run. Remember that this is a 2-year facility, so it's not going to just, come up and then we see that liquidity flooding Nigeria in 1 year. It's a long run effect. So in the long run, over the next 2 years, the 24 months, we should see that increase in the base that banks are able to use it. Because remember, these funds, when the capital is raised, it's not just going to sit down. The money is not just going to sit down in the bank's balance sheet. They're also going to sweat those assets, to be able to get more, returns on them, and of course produce more returns to their shareholders. Like Prab just mentioned, the EPS is likely. I mean, the fact that the share capital is increasing should lead to a reduction in EPS. But banks are going to want to avoid that by, giving out more loans and being able to get more returns, to increase their earnings to shareholders, and of course, maintain their EPS or even increase it beyond what we have. So, but then that there is a limiting factor of the rates, the MPR rate, which is a benchmark rate for all the rates in the industry, in the banking industry. So, right now, we expect that in the long run also we are going to see the Monetary Policy Committee also begin to reduce the MPR rates, so that incentivizes every other Nigerian to get these facilities and then, of course, be able to achieve the dream you're painting. But right now, we're not expecting that massive influx. The 4 trillion is not likely to come at the same time. So we are going to likely see it in phases. Can anyone hear me?
Yes, we can hear you.
Okay.
Loud and clear, loud and clear.
Okay, there was a brief interruption. Okay, so we're likely to see that the funds, the capital coming in phases, and of course, this should have a long-run impact on the economy. And one thing that all of us are really not all of us, a lot of people are not really also thinking about is the fact that this also has a long-run impact on inflation, because in the long run, you are increasing the capital base of banks. This money is not going to sit down with the banks. They're eventually going to churn it out into the real economy. Remember that one of the main things that the CBN wants to achieve is a $1 trillion economy. You cannot grow your economy from a $250-something million to a $1 trillion without significantly increasing your inflation rates. But there's also the part of the exchange rate appreciating, which is good, which the appreciation of the exchange rate would also lead to increase in the achievement of the $1 trillion economy. But the exchange rate alone cannot do everything. We will also definitely see some impact from inflation. It's just a pure monetary term. So companies might need to brace up for, you should see that inflation decline maybe in the short term, like in the long term, the central bank has alluded to, and Dr. Bumi also mentioned that during one of the answers that she was giving. There's a likelihood for decline in inflation, say second half of the year into 2025. But going forward, as we start to see that money supply increase in the economy, because remember, increase in the share capital base of banks is likely going to lead to higher credits to the private sector, and of course that should lead to higher money supply. We should see that impact on inflation in the long run. But then in Nigeria, our inflation is not just affected by the money supply bit of it. There is also the fiscal policy bit of it. So if we see a scenario where the fiscal authorities are able to significantly tackle the inflationary pressures we are having, say we see a significant reduction in insecurity, better conditions for farmers and food security in Nigeria, this would kind of moderate the impact of the higher supply that the banks are going to see in the long run. So Prof also mentioned that shareholders might start to favor on the capital market. Shareholders might start to favor bank stocks over other companies. This is something that we're already seeing playing out. That's the structure of and the liquidity of the capital and on the Nigerian Stock Exchange now. We have more liquidity for the banks. The banks' stocks are more liquid than other stocks anyway. So I agree with that, thought process that we're going to see some bit of crowding out there, but that's more like what is already happening. It might be more enhanced due to this capital raising effect, but yeah, we're likely to still see that play out. The government cannot be effectively run on just equity alone. So there would also definitely be increase in credits to the government, because we look at our budget deficit. The budget deficit cannot be cannot be sponsored. The budget alone cannot be funded by revenue. There would need to be borrowing in that budget. And if the domestic environment is capable, the banks, the domestic banks, and the investment climate in domestic space is capable of funding the government budget deficit, that would reduce their need to, you know, sort for external funding. So of course, there will still be external funding, but the need will be reduced. So this all would play out in the long run to see increased credits to both private and the government. And of course, the expectation is that in the long run, over the next 2 years, we should also see the Monetary Policy Committee begin to wind down their aggressive rate cuts. Their aggressive rate hike, and we should start to see rate cuts that should incentivize people like me, you know, to be able to go to the banks and get some of these rates, and of course, achieve Rotu's dream of the big house in the Bahamas.
Amen to that. Amen. I'm okay with the house in Lagos. So we're in Delta State, where I'm from. I don't have to go to the Bahamas. Thank you so much, Praise. Our panelists, very, very robust, insightful answers we're getting here. Dr. Bumi, let me come to you with respect to trade. I think I've come to you now on trade 2 times in a row now. But what does this recapitalization mean for banks in terms of international trade, trade finance, cross-border settlements and stuff like that? How do you see that being impacted?
Okay, thank you. So being the banker in the room, I will speak from a broad banker's perspective. Number one is that the enhanced level of capitalization would ultimately increase banks' capacity for improved financial intermediation, which would enhance the level of economic activity. The Nigerian economy has actually gone through a lot, over 103% devaluation in the years past, in addition to further devaluation this year. If I want to put, the implication of that is that the bank will have shrunken significantly in foreign currency terms. If I want to, a better way of doing it is to actually just put some numbers to it. So post-consolidation in 2005, there were 89 banks in Nigeria. Of those 89 banks, at the point of consolidation, about 65 over between sound and satisfactory. 11 banks were deemed marginal, and then additional 12 were deemed unsound, with about 2 not even rendering any return at all. So it was not difficult to see how it pans out, because about 20 banks already have capital that was between 10 billion to 20 billion. So it was just not a surprise that only 24 banks survived that encounter. The situation is quite different today, but putting numbers to it, 25 billion in 2005 was equivalent to $194 million. As of 2014, that figure, the exchange rate had moved from 129 to 179. So there was a slight decline. But as of today, let me just come today. If I use the exchange rate or an average exchange rate of 1,400, that 25 billion, which was 195 billion roughly, is about $17.9 million today for the topmost of bank, the international bank. In terms of the national bank, the 15 billion capitalization, which was $116 million as of 2005, is now about $10.8 million. Although there were no merchant banks as of the point of after consolidation in 2005, 2006. If I mirror the 10 billion capitalization of merchant and regional bank to present situation, as of 2015 numbers, that would be about $77 million. In today's term, that 10 billion is equal to $7.2 million, roughly. That seems a bit ridiculous. What would the topmost of banks do with capitalization of less than $20 million? And then the merchant bank, which are supposed to be the engine room of growth, are having base capitalization of 7.1 million. I know like the Fugas Bank have higher capitalization than the 25 billion. But that is the situation given what we've experienced in periods past. What that means is that for an average cargo of crude petroleum, that the LC size, because you told me to come from a trade angle, is about $90 million. It means that for a typical national bank to do LC of 90 million, post-shipment finance, that LC would need to be syndicated amongst many banks. Don't forget that it's not this 17.9 or 7.4. The SOL, the single obligor limit, is 20% of shareholders' fund. So it's not, so at 20% of shareholders' fund, the maximum LCs per shareholders' fund is about $3.5 million. Where would we go for that? So there is no dialogue around, oh, there is need for improved capitalization. The unknown was the level, the magnitude, the size of capitalization. Added to that, the Nigerian banking industry is largely concentrated. In fact, the notable measure of concentration is what you call the Ackman-Ingham Index. For Nigerian banking, that ratio is well above 0.18, which is the highest in terms of concentration. So if I give that, the top 5 banks, in terms of total asset size, the total asset size of Nigerian banking, I will use 2014 because that was the period where we had a lot of stability. The total asset size of Nigerian banking industry in 2014 was about 32.5 billion. As of today, based on NDIC figure, in 2001, the top 5 banks already have capitalization of 34-point-something billion, trillion dollars. I mean, 34-point-something trillion naira. But in terms of the dollar value of that 34-point-something, $34.4 trillion was about $188 billion in 2014. Today, that same figure for the entire top 5 of the banking industry at current level is about $42 million. So 188 versus $42 million. In terms of total loan, the top 10 bank accounts for 80% of the total banking industry. In terms of deposit, the top 10 banks account for over 81% of the total 25 trillion deposit in the economy. What capitalization does is that it now allows for diversification and dilution in that concentration by making sure that the smaller banks at least get bigger and we can do bigger transactions. I'm a banker. Let me put on the table also that it's not all about capitalization, even though it is very essential. It signals strength, it signals resilience, it signals stability and capacity. There are other risk divergence measures that banks utilize by partnering, collaborating with African-focused development finance institution, right? For the bank I work for, if I'm allowed to mention, I work for EcoBank Transnational. We built a competence in this regard. We're able to partner with a lot of DFIs in terms of enhancing our lending capability. We have the African Trade Insurance Group, we have the African Guarantee Fund, IFC, amongst others. So our banks can actually leverage risk sharing, risk participation guarantee to enhance their capacity. So even if your shareholders fund is currently at 7-point-something million, you can actually do more. If you build your competence, there is trust, you build more, and then you can do a lot more. But as of today, I also note Professor's comment and Ugo's comment around why is retained earning not acceptable. Yes, I share your sentiment because the Tier 1 capital is the first line of defense to absorb shocks. And composition of Tier 1 capital would be your common equity, your retained earning, and your share premium. Is it unusual that the central bank had said no retain any. Maybe not. Number one, it follows practices in some other economy, is their prerogative. In Burundi, Gambia, and then the government of the Francophone, the Central Bank of the Francophone, the BCAO, in December also issued a circular mandating banks to capitalize from 10 billion CFA, which is about $16 million, to 20 billion CFA, which is about $33 million. Retain any was not part of it. So I wanted to beg that. But in terms of CBN focus, CBN is the regulator. So it's for banks to comply with what the regulator deems is appropriate. The thing is that, fairly speaking, the Nigerian economy and even banks have been subjected to a lot of headwinds in past, coming from COVID, coming from the high inflationary pressure, exchange rate. A lot of things have happened. Like I said at the opening, those are not without consequences. So I'm believing that CBN, being the regulator, having the regulatory oversight, the supervisory oversight, perhaps they know more than we know, and then perhaps they factor in the likely effect of all of this shock, and they feel the retained earnings should actually do what they are meant to do, which is to absorb shocks that might come from defaults, customer reneging on agreements, all of those, and all the macro headwinds. So we have to take it as given. Finally, what I wanted to also point out is that if we remember, the consolidation exercise of 2005 took banks to an unprecedented level. By consolidation, the bank's share of capital markets grew from 25% to 38% of market capitalization. The sudden surge in liquidity brought about the impetus or the need for banks to expand, to also deploy those capital to enhance the the return on equity to their shareholders. What happened subsequently, culminating in the rescue of about 10 banks subsequently? Hindsight, it seemed that neither the banks nor the regulators were prepared for the significant and accelerated growth of banks. So the banks took so much risk that then led us to the path of rescue and write-offs, which came to about 6.6% of the total equity of the banking industry. My charge today, given that we've now moved from compliance-based supervision of the central bank to risk-based framework and then to other moderation, is that both the regulatory authorities, the banks, and even the analytical community should be on the watch out so that we don't have a repeat of 2008, 2009 debacle, such that what was originally supposed to be a source of strength, joy, enhancement of pedigree does not become a source of a sore point to the economy. But as we stand today, in closing, the Nigerian banks cannot effectively compete with their peers in North Africa, in East Africa, on the basis of foreign currency. If we are saying the total industry asset is $45 billion, don't forget that most of the FUGA banks, as of 2015, already had total asset size individually of well above 17. So are we going forward or we are receding? I think this is the case for capitalization. Thank you.
My word, Dr. Bumi, that was really good. That was highly informative. This is the reason why people keep signing up for these nairametrics discussions, because the panelists are just so incredibly insightful. Thank you very much for that. Thank you for the numbers. Thank you for putting it all in perspective. And thank you for the examples. I think you mentioned Burundi, Gambia, and others, and the CFA recapitalization as far as the banks there were concerned, and the exclusion of retained earnings. So it's not unique to the Central Bank of Nigeria. That was really, really good. We need the video of this session, all right? Because I think I want to play back a lot that has been said today. All right, we are actually at our final session now. So I like recapping these things. We've talked about the notable CBN policies and the potential areas of impact. We've talked about the core mandates of the central bank and whether all these policies, all these circulars align with that core mandate. We've talked about the very, very headline-grabbing discussion on the recapitalization of the banks and, or rather the threshold, excuse me, higher threshold. They got 2 years to get that done and what it means for the sector. Now, future outlook. What do you all think is going to happen going into the second, well, we're in the second quarter now. I want to start with monetary tightening. If you're holding Naira assets, and you're looking at your T-bills, you're looking at your, money market instruments and fixed income and things like that, bonds and so on, you might be smiling. Dr. Ugodre Adedipe, let me bring you back in. What has been your perspective of the tightening we have seen, I guess, on the perspective of those holding Naira assets? Do you expect that to continue if between now and the next MPC meeting in May, we get higher movements in inflation? So how do you see monetary tightening? Will investors holding Naira assets keep on smiling, Dr. Ugodre Adedipe?
Well, essentially, monetary tightening is attractive to investors holding Naira assets. And like you said, especially those that invest in fixed income securities. And we see it already playing out. I mean, just take what happened this week to illustrate. Now, the central bank put out treasury bills of 3 different tenors. 2 tenors were heavily undersubscribed. 1 tenor was heavily oversubscribed. Now, why did that happen? Most investors went for the 63 days bill. And that was, they put out about 642 billion naira in that particular tenor. And now you look at the other tenors, significantly lower than the volume that CBN put out. What does that mean? That means most Naira asset investors, taking treasury bills as an illustration, wanted to lock in on a long term at the current high rates that, of course, we are influenced by 2 things CBN has done. Monetary policy rate now at 24.75%, and then indexing treasury bill rate to the MPR, which, of course, CBN, decoupled both for several years until it happened recently. So now what that means is that MPR at that high level, treasury bill rate indexed to that, makes that particular Naira asset very, very attractive. Same thing, I will pick up another one. Flat mills of Nigeria, and that, of course, runs contrary to what Praise said earlier on, okay? And that is why you can't really say that bank recapitalization will essentially, crowd out the other segments of the stock market. Flat mills put out a bond this week at 21.7%, coupon. And of course, I've seen quite a lot of interest expressed by investors that we have relationship with. Now, what this also means essentially is that even private companies will put out their bonds in light of what is happening within that market. Now, the critical thing here, which I also want to bring into conversation, is the play against the stock market. And that is the traditional, what you might call it trade-off in a way, that once Naira assets are more, attractive because of the high rate of return and yield on them, the likelihood is that some investors will move away from the stock market. Now, if you look at this Nigerian stock market, up until the middle of March, it was going very well. Second half of the month of March, and then, of course, we are in the beginning of April. You notice that the index has been struggling between 103 and 104, unlike what it took to get to 40.5% year-to-date return that the market had recorded from January till date. So what that also means is that the attractiveness of Naira assets is not making the stock market to maintain its growth pattern that has demonstrated since June 2023 up until date. So therefore, I expect that to, of course, push private bond, like I said, and of course, capital raising by some private entities. The second line to it is whether this is likely to continue till the end of second quarter. And I believe this will likely continue. And in fact, until we see inflation moderate, in which case we are likely to see the rate currently sustained as MPR and the attractiveness of Naira assets to investors. And of course, we may see a symbolic reduction of the MPR in the second half of the year. I say symbolic, not a major, downward mark, but symbolic in the sense that, yes, once inflation begins to trend downwards, and we have an expectation that inflation this year will likely trend down towards 23.47%. That's our expectation. So if that happens, then we expect that it will still not discourage investors in Naira assets because MPR will not come down significantly. I don't see MPR going below 20% this year. So if at all it comes anywhere near that. So let me also mention something before I stop here. One is the audience must understand that banks don't lend out of their capital. Okay? Banks don't lend out of their capital. All right? So we must understand that. When there is a call for more capital, like central bank has done now, what it means is that central bank is expecting the bank's capacity to grow their business and be able to support the economy, to increase. So that is what is playing out here. So people should not go away with the thinking that, banks will now be able to lend them more because they will have more capital. No, capital will expand their capacity, and that capacity will make them expand their business platforms to be able to draw in more deposits. Banks lend out of deposits, not out of capital. Then secondly, and that's will be my final contribution here, on money supply. Now, oftentimes, we made reference to the data earlier on, 63 trillion naira about June 2023. Now we're looking at about 94.7 trillion naira latest data available. Now, we forget something, and that's the fact that this economy is still cash-driven. About 80 to 85% of transactions in the informal sector are cash-driven. Then, even in the formal sector, as we have it, about 40 to 45% of transactions are also cash-driven. So when your economy is growing, and there's no doubt that your economy is growing, because I don't want us to lose sight of that. The economy is growing anyway. So what is the problem? The real problem of the economy is the Naira exchange value that made GDP to contract, bank's balance sheet to contract, every company's balance sheet contracted because Naira was losing value. So the economic narrative nominally is growing. And when the economy is growing, there's a certain volume of cash required to fund transactions within that economy. Now, bringing that also to the fiscal side, there's a connection. The money supply you see there is also a reflection of the fiscal operations of governments at federal and subnational level. We must not lose sight of that. So when we therefore talk about fiscal interventions, about what should our government spend the more money they are getting from the fiscal, allocation account, financial account. So what should they do with it? Should they just spend the money, or should they invest it in infrastructure, which is growth enabler? I think that is the real direction we should be pushing the conversation with respect to, fiscal operations as supporting central bank's activities in checkmating inflation and also beginning to drive growth. Thank you very much.
Dr. Adeleke, that was perfect, because where you landed is where I want to take off with Professor Onakoya. Professor Onakoya, you've heard Dr. Adeleke talk about the need for the fiscal side to step up. Now, all this can't happen with just the monetary side alone. Professor, which ministries would you say need to help out? Because I have some ministries on, trade and investment, for example. But I want to know what your thoughts on the ministries that should be aiding the monetary policy authorities. We have a coordinating minister of the economy. What should that minister? What priorities should that ministry be? That minister be focusing on? So, Professor Adaka, let me get your thoughts on the kind of support the monetary side needs from the fiscal side.
Okay, to answer your question, simply put, all the ministries. What do you understand? What do you mean? All the ministries are engendering productivity, whether it is agriculture, whether it is petroleum resources, mining, all the ministries that are promoting the real sector will be involved. But that was just a simple answer. We need to look at the relationship between the monetary policy and the fiscal policy. And it's a very simple model that talks about government budget deficit on cash basis being a combination of, one, the net placement of government bonds, both in the foreign and the local market, and the change in monetary base arising from CBN credit to government. Those are essentially two different sides of the same coin. And there are three scenarios emanating from the interface between the monetary policies and fiscal policies. Scenario one, where CBN is dominant, like in the past government. CBN could determine the growth of the money base independent of the financing needs of government. Oh, I'm sorry. That is where government is, our last government had the government be essentially in the dominant position. And because the government was dominant, they determined the size of their budget deficit without consulting the CBN. So CBN was made to supply any money that was led by the Minister of Finance using ways and means. And we know that we also went far beyond the threshold, and that led to inflation, led to depletion of our foreign reserves, high level of debt servicing costs, it stifled development and domestic market, and constrained the development and governance financing. We now know where we find ourselves. 22.7 is it 30 trillion ways and means that the legislature tried to legalize illegally as against the provisions of the CBN. So essentially, both the monetary authorities and the fiscal authorities need to work together. And for that to happen, there must be in place an independent CBN, which this particular current administration seems to be enabling. But then there must be in place a coordination committee of both the fiscal and the monetary authorities to resolve and prevent conflicts. And that is also being shown by what the different committees that the government is trying to set up, involving even the private sector, major private sector players, to be part of the policy drivers. There must be limiting direct CBN credit to government. That's also in place. The CBN Act talks about maximum of 5% of the government revenue of previous year. And the last National Assembly tried to increase that to 15%. In fiscal, we're supposed to have, according to the Fiscal Responsibility Act of 2007, we are supposed to have not more than 3% of GDP as fiscal deficit. But we went far ahead, far beyond of that. This government has actually brought it down for 2024 to about 3.88. And we should have establishment of a separate debt management office that is independent and working. So it is really why this in place that things will start to move. But we essentially have most of these in place. These institutional and legal safeguards are in place. But rotus, they are not justiciable. They are not justiciable. Nobody is getting penalized for breaching the law. No criminal charges have been brought against anybody for exceeding the 5%. What that means? Nobody has been sent to jail or for prosecution for exceeding the 2007 Act of Fiscal Responsibility Act on budget deficit. Until we start to enforce our laws, you can have 10 ministers, coordinating ministers of the economy. Not much will happen. But going further, all the ministers are involved. We need two things: efficient fiscal spending, efficiency in fiscal spending, and sustainable structural economic issues such as infrastructure, like Dr. Adetupe mentioned. All this will promote productivity, and it's from there that can start to balance fiscal policies with monetary policies. But since we are still an crude oil dependent nation, oil price volatility will continue to play a major factor because the prices are exogenously determined. Political interference becomes another issue that constrains the performance of both the fiscal and the monetary policies. Information asymmetry and the growing debt are also major issues. Finally, I just stop at this point. The differences in the policy transmission mechanism will need to be managed. We need to be managed. We need to be harmonized. If you're going to be serious, these economic committees were also set up under President Buhari, consist essentially of most of these same people. I'm talking about new wine in old bottle or new bottle containing old wines. Rotus, I yield back.
Professor, thank you for that. Some very, very solid points that you raised there. We're not seeing the prosecutions, we're not seeing everything is laid out there, but we're not acting. The authorities that are supposed to be acting on it are not acting on it. You talked about, of course, the need for efficient fiscal spending. Very, 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 very important. Professor, thank you so much for that breakdown. And you said all the ministries have to support the monetary policy side. Thank you so much for that. Praise. Let me come back to you. As far as future outlook, capital markets, right? With respect to how the CBN policies will impact the capital market. I mean, we've seen the NGX. Dr. Adetupe was talking about how higher money market and fixed income rates affected it. So how do you see, Praise, the capital markets in the second quarter and things going forward?
Of course, it's not going to be wise to ignore the impacts of the fixed income markets on the equities markets, we've discussed. For the second quarter of 2024, the likelihood is that the monetary policy rates, and as is expected, is going to remain elevated. We're going to still see monetary policy rates where we are. And the fact that the signaling effect between the monetary policy rates and rates in the fixed income markets have become better. Because of that, fixed income rates in the fixed income markets are now predominantly attractive, and that should remain in the second quarter of 2024. We should still see that attractiveness of rates in the fixed income markets, both on the primary auctions, the CBN, the bond auctions, and even corporates too, the commercial papers, the bonds, all those instruments. We should definitely still keep seeing those rates at attractive levels, and that would keep the attractiveness of investors towards the fixed income market. However, some investors are also, we're still going to see some participation in the equities market. What would play here is the liquidity aspect. The liquidity would determine if we're going to see a flow of funds into the equities market, but more of the funds, of course, would be to the fixed income market. Like we've also discussed since even from the beginning of February, actually. January was very positive in the equities market because at the beginning of the year, we entered the year with such significant runs in the banking sector and some other stocks, and then some major bellwether stocks like Dangote Cement that are significantly that have significant market capitalization, we saw Transpower listing, and then Geregu and all these other stocks that have significant market capitalization, and their prices don't change easily. And those stocks recorded significant gains in January. And so that's what has mostly kept the year-to-date at the 40% that we're seeing. There's been some more volatility since beginning of February when the monetary policy started to hike rates, and of course less participation in the equities market because, of course, like I said, the fixed income market is now more attractive. So that dynamic is likely to continue to play out. This will really definitely be a trying time for businesses that have to come to the market to raise funding in the fixed income market, because now you're going to pay more to be able to get to be able to attract investors to your commercial paper, to your bond. You're going to, of course, have to increase the interest rate you're providing on this instrument. So the capital market right now, I would say, is actually a very good time for the fixed income market, because we haven't seen this kind of play in a while. It's been more of before this monetary policy came into effect, it's been more of, yes, hiking in monetary policy rates, but really no signaling effect in the fixed income market, because there were little or no instruments to play in the first place. For the primary auctions, CBN auctions. And so seeing that shift move from that kind of relationship between the monetary policy rates and the fixed income rates to what we have now has been a very significant determinant in shaping what the fixed income rate is and what the investors are likely to do. So for the second quarter of the year, for the next monetary policy committee meeting is in May, and pending what happens with inflation between now and then, there is also a likelihood that the monetary policy committee will remain aggressive. Maybe not as aggressive as they have been in terms of doing 600 basis points in the first quarter, but the likelihood is that they will remain aggressive in their stance to continue to combat inflation and continue to make sure that we see inflation at sustainable numbers for Nigeria. So with that in mind, with investors having that in mind, there's also going to be that continued reliance and continued expectation and continued demand for higher rates in the fixed income market, which would definitely see the impacts play out. And then so for investors that are going to stay in the equities market and continue to play in the equities market, the play is going to be for stocks that are fundamentally justified, stocks that have fundamental basis, and stocks that their technical performance is very strong. You would see stocks like that in the banking sector. You see stock like that with some bellwether stocks like a Dangote Cement, that when you analyze some of these stocks from their fundamental base, from the performance of the company, from their earnings, from their corporate performance, from their corporate strategy, from their business orientation and all those things, they would provide that support to investors that still would prefer the equities market. So that's what we're likely to see happen, as opposed to equity investors just buying anything. There would be a lot more, there should be a lot more attention to stocks that are fundamentally justified in the equities market, so that that still gives you some comfort level as an investor to invest in the equities market. And then, of course, the other explanation for what we are likely to see in the fixed income market.
Thank you, Praise. Dr. Bumi, I'm coming to you, and I'm not going to ask you about trade, all right? I'm not going to ask you about trade again. I want to ask you about foreign exchange. The CBN has been clearing out valid backlogs. You also have the Naira appreciating, from 1,800 levels coming down to about, all right, I'll come clean. I sold some dollars on the black market yesterday, and it was at 1,225. So just to give you all some information, I needed some Naira this weekend. It's appreciated, but can it be sustained? Can it be sustained? Again, I bring you back to the Nairametrics Nairametrics article leveraging on Nairalytics analysis of the first quarter interest payments on NTBs, on Nigerian Treasury bills, hitting ₦1 trillion. So, attracting FPIs and all that, FX, can that be sustained going into, as we look at this future outlook, Dr. Bumi?
Thank you very much. Yes, in my view, it is actually quite sustainable, and sustainability is a possibility. The first is that a lot of gains have been recorded, and it is my expectation that those gains will begin to trickle down from Q2, and we'll begin to see the impact. But there will be some downside to this. Sustainability will be hinged on some basic factors. Number one, that the backlog that we experienced in periods past, coming to circa $10 billion, will never be allowed to return. Expectedly, under a guided free floating regime, interest rate targeting, as the CBN has said, should be their focus. So they have no business really with exchange rate management, if truly we're pursuing the path of floating. So I would expect that there should be no backlog. There should be free entry, free exit. They should maintain the two-way code system, and this will ensure stability of the economy and the FX market. To achieve this, trust and confidence are imperative. If the CBN maintains current trust level, then the confidence of the investing community should return, and we should have positive vibes continue, and they will see appreciation and moderation in exchange rate. In terms of ramp-ups, we need to ramp up on oil production. Every 100,000 barrel additional production is actually current account positive. It gives net revenue of between 2.2 billion to, 2.2 trillion to 3.3 trillion naira, depending on the exchange rate you use. The Dangote commencement of production is very current account positive. It should enhance our current account position. That being said, I told you confidence is an imperative. Confidence will be reinforced if we have transparency and effective forward guidance in the conduct of the regulatory authority, and that will percolate to major operators, the banks, the IMTOs, the BDCs, and every operator. What we've witnessed in Nigeria has happened to some other economies like Kenya, where they also have significant volatility, speculative attack in the past year. But right now, stability is maintained. Stability got maintained because at some point, the government saw that, wasting reserve, defending currency will not cut it, and they put in place effective mechanism. And by so doing, with the transparency, they've been able to assess the bond market, the stability of exchange rate. At some point, devaluation moved from 103 shillings to about 190 shillings in the parallel market. Today, they are back to the 130, 135 level percentile. That is what I expect to see in the Nigerian economy. But there are two elephants in the room. Based on discussion that I have had, before I talk about the two elephants in the room, one positive thing that the government have also done, which I talked about, is to enhance the trade facilitation capacity of the economy. You will have heard about 2 weeks ago, the government saying, they are now ready to sign on to the European Bank for Reconstruction and Development uptick. That is very fantastic for the economy because the EBRD is one institution we have engaged across different geographies. They've recently onboarded about 10 African countries. Nigeria was not one of them. It was a shocker to myself and the rest of my team, but it was so gratifying to hear the Minister of Finance saying they're not willing. That is an institution with about 30 billion of assets. Imagine what leveraging those kind of platform, in addition to all of the ones I've mentioned, could do to the economy, could do to trade enhancement. They have a lot of products in the green space. Secondly, we all went to COPs. Some people thought it to be jamboree. The central bank and the fiscal authority should now begin to assess before the next COP what has been achieved. There were contributions towards several funds. One was the loss and damage fund that had about $750 million contributed. Let's take out the US that has climatic needs because owing to all of their climatic volatility of about $150 million annually. What are we of Africa? We have a lot of states in eastern Nigeria, in western Nigeria, suffering from gully erosion, suffering from different climatic environments. How much of that 750 have we annexed is coming? And we're looking for forex. That is one sort of forex. In closing, it's not about banks alone. Yes, it's good to enhance the capacity of banks. But if you enhance the capacity of banks, where else do you want the banks to deploy their resources they are able to harness because of their capacity enhancement? One sector that we need to look at is the mining sector. That is a sector that is powering a lot of our African nations. Guinea just brought on board the $20 billion Simandou project. DRC is doing that. They are not even content with having the mineral in the ground. They are now plugging themselves into the value chain of the mining so that they can earn better returns. You have the #1 copper producer in the world, which is the DRC, coming in conjunction with Zambia, the #3, coming together to say, okay, they're not going to supply raw material for battery production. They now want to set up a battery processing plant in Eastern DRC. Those are the kind of things I expect the Nigerian operators to begin to look at. Nigeria sits on top of above 54 different minerals. What are we doing with those minerals? It's not just about lithium. Lithium is an opportunistic material. A lot of countries have lithium. But the ability to harness the resources, the value addition we do, we haven't even got started. So while I see the likes of Thor doing what they can do in that space, there is the need for government to attract serious players into that sector. You have the China winning consortium in Guinea, you have the ERG, you have Invanho. I want to begin to hear those kind of names talking about operating in the Nigerian environment. I think if we're able to do this, then I'm talking about the elephant in the room. When we talk about transparency, we talk about ease of business. I'm happy to see the government engaging the investing community. But I think there's a need for the government to also engage the international organization. Don't forget that during the Emefiele regime, there was a lot of battle cry with international organization. A lot of those flows that should have come into the covers of government have found alternate means because they must fund their operation in Nigeria. The CBN should look in that direction and engage them. Lastly, one question we've often gotten asked is, what is the role of the central bank in the sale of, let me say, the Union Bank and the debacle? Because these were transactions between two private organizations, Atlas Mara and another operator. It would be good as a means of forward guidance for the CBN to actually explain what. So there was an amalgamation of two banks that became Union Bank. What happens to the first bank? What happens to the second bank? What is the status of that organization? I think CBN ability to clarify that will further reinforce confidence of the investing community that Nigeria is a good place to look at, even as we start on the path of capitalization. You can't say people should come and invest in bank and they don't know whether a year, 2 years down the line, there will be unveiling and then there will be question. I think that's issue. It might have been quietly bedded. I think the CBN owes the investing community, even the finance sector, and even the citizen of Nigeria, some clarification why the current situation is and what is the remedy and how do we move forward. I think that is very important as we look at recapitalization of the Nigerian banking industry. But on balance, it is fantastically positive, but those two issues should be bedded so that we can confidently engage the investing community in terms of investing in Nigeria. We don't want to hear them telling us about Union Bank, Titan Trust, all of the time. It's high time that is addressed. Thank you very much.
Dr. Bumi, that was just wonderful. Yes, we need to hear from the CBN. They need to tell us, look at that. So see the comments, just fantastic. And I could shake your hand and it's a weekend, maybe buy you a smoothie for your comments on the mining sector. Tesla is going to India to go and look for a site to build a new factory. We're sitting on the materials that these companies use for their batteries for electric vehicles. The mining sector really has to, we need to sweat the capital, sweat the assets that we have there. That brings us to the end of these sessions. These have been so good, so informative. Our panelists have been fantastic. And I believe that there will, of course, be a Q&A session coming up in just a moment, where folks that have questions, I think that have been sending questions, to get them answered. But I believe we have to hear from our sponsors again. Shout out to Deal Clinchers and also NMRC. All right, so, as we've talked about the ICT sector and how the ICT sector is one of the potentials for us to grow, the internet has to help us out. But as you guys can see, NMRC, they're helping out the people as far as being able to live the Nigerian dream and get a home. So that's what you're seeing right there on the screen there. So shout out to them partnering with Nairametrics, putting this together. It's all about home refinancing and being able to get a nice backyard with a dog and some kids running around, where you can host parties and stuff. So it's really good to see that the NMRC, the Nigeria Mortgage Refinancing Company, is trying to make that happen. You guys see that? NMRC keeps long-term funding flowing. Very important. Very, very important. Hey, see, there's a family with a dog. Who saw that? All right, shout out to our sponsors. Shout out to our sponsors. That was a very nice touch with I think it was a husband and wife and I think it was a Labrador Retriever or so. All right, we're gonna hop into our Q&A, and we have a number of questions out there from our participants. Right? I don't think we call them an audience. We call them participants. Okay, this is a good one. This is a good one. Who wants to take a stab at this? I think Ugodre should even answer this one. Taiwo Popola sends in this question. A lot of questions on foreign exchange. Can the Naira reach 900 to the dollar? I mean, can it? Okay, Dr. Bumi went last. Let me ask Professor Onaka.
Yes.
Yes. Oh, okay. Ugodre is actually okay. Ugodre, yes. What's the fundamentals? How's it going to reach 900?
Yes, you can. I mean, you got to look at the key drivers here. This is a demand and supply play. If we keep attracting a lot of FX inflows, say we see capital importation I think last quarter we saw $3 billion. If we see another $5 billion Q2 and maybe another $10 billion Q3, of course, vis-a-vis keeping interest rate high and seeing capital inflows coming, and then crude oil prices still high, and Nigeria's crude oil output increasing, it is very, very possible as within reach. Remember, we went from 1.6 or 1.7 to about 1.2 within a month. And so it's not far-fetched, very, very possible. But of course, again, it's a demand and supply play, Rotu. So just to be cautious there.
Thank you for that. Does anyone else want to chime in on the exchange rate reaching 900? Ugodre sounds bullish.
Yes, okay. Yes, okay. Onokoya here.
Okay, go ahead.
Don't forget that 800 naira is the budget exchange rate. Probably the exchange rate has been the exchange rate of the budget has been predicated. It was only a tactical move to battle the alternative market that made the government to the CBN to move the exchange rate to meet where the alternative market price was. The 2024 budget is, as approved, is still 800 naira to the dollar, not 1.4. So it is doable. We will continue to, like Ugo said, it's a demand and supply situation.
Thank you for that, Professor. Yes, thank you. I have another question here. It's from Ayo Ojunuga. It's about, no, sorry about that. Adekunle Alakuro. In trade, what's really happening with our borders? Are they still closed or what? Weren't the borders partially reopened? I mean, not all of them have been reopened. Who can help out with that? Is this what with the borders as far as movement is concerned? I think they are. Let me see. Dr. Bumi, do you think what's your read on what's been happening with the borders? I think they're partially reopened, right? Not all of them.
Okay, I mean, based on what I know, there was a presidential directive to have all the borders open. The borders that were supposed to be closed were the ones to Mali, Niger, because of the sanction, but there was a presidential directive that they should be open. And that's one of the forward-looking guidance regarding the direction of inflation rates, that as the borders reopen, prices of essential food items should begin to come down and inflation should moderate. So except someone is not obeying directive, they should be open. Thank you.
Thank you for that. Let's see here. We have, okay. I thought I heard somebody else trying to chime in. Okay, there are lots of questions here. Okay, this is another one. Praise, let me lob this one at you. This is from the initial question I was going to read from Ayo Odunuga. He says, what happens when these hot money investors want to repatriate their money in dollars? Praise, what happens? We should have the liquidity to give them their money back a year from now when the money markets, instruments, and so on come due. Yes, what do you think?
So this is exactly why we are clamoring that the short-term policies that the CBN is doing is not effective enough, because it has happened before, where, in 2016 we saw rates begin to increase, and then you see, if you were here at the beginning and you saw the presentation that Ugo shared, the COVID-19 pandemic triggered significant exits from foreign portfolio investors from Nigerian markets. And, that's, of course, we are still seeing the impact of that on the foreign exchange market. There was the issue of capital repatriation. That's where the issue of the backlogs were coming up from. And so it's a very, very high possibility that can happen again. It has happened before. So if we continue to see this foreign portfolio investments coming that is not backed by more sustainable FX sources in terms of revenue, in terms of, revenue from more sources outside oil and all that, the likelihood that if there is a significant shock to the global economy or just something significant that happens in Nigeria that just triggers that massive exodus of foreign portfolio investments, we're likely going to see that significant devaluation of Naira happen again. And then it would be a case of, we've been here before, are we replaying what has happened before? So very important. And I think that's one of the main reasons of this conversation today, to just enlighten and speak on other ways to make sure that we're having sustainable FX sources and not just FX sources that can be triggered by a significant exodus and shock.
Thank you for that, Chris. Thank you. Ugodre, I think this one is for you, unless anyone else wants to hop in on the stock market. Although this individual didn't leave a name, question is, from a dividend yield perspective, are stock prices not overvalued, as we would likely not see dividend yield of 10%, especially at current inflation levels? Ugo, what's your take? How about Stock Selector? Ugo, I'm a big fan of Stock Selector.
It's coming back. Stock Select News like is going to come back. It's going to come back. We're working on it. So brilliant question, but you got to look at Nigerian stock market historically. So historically, dividend yield has always been between 5 and 7% historically. Even in the days of low interest rates, high interest rate, it's always been around 5-7%. So dividend is not really a very solid way of looking at stock market returns, even though a lot of us, like me, I love dividend, but it's not how you look at stock market return, especially if you look at values or look at dividend yield from the point of view of current share price. So, but if you look at dividend vis-a-vis, maybe share price, historical share price when you came in, then you could see yields at about double digits. So the current valuation you're seeing now is not about dividend. It's basically investors repricing stocks in dollars. So they think that if you reprice those stocks in dollars, they actually are cheap. And think about it, a lot of banks today all trade at earnings per share of less than 4 times. In fact, it's just this year that we started seeing them at 4.5. Historically, over the last 5 years, they've been trading at less than 2 times. And a lot of them still trade at less than their book value. So that's what investors are looking at. And investors also look at peer group comparisons. So they look at a bank in Nigeria in terms of their earnings multiple versus a bank in, say, South Africa or Cairo. So those are the kind of things that they look at. And then there are also a lot of invisible hands that tend to move stock prices in Nigeria. I don't want to go there, but there are invisible hands. So when you're looking at stock market valuation and whether a stock is cheap or not, don't focus on dividend yield alone. It is a wrong way of valuing stocks in Nigeria. It doesn't mean that you don't use it, but don't use it in isolation. Rotus.
Thank you so much for that. Okay, look, you know what, Ugodre, what you just said, can I throw in my own question? Speaking of the invisible hand, I don't know, maybe all the panelists would write it. Is the Naira floating or not? Because that's my question.
Prof, I'm sure Prof will answer that.
Prof, is the Naira floating? Because they said it's a managed float. If your currency is floating, you should be doing this on the charts. But Professor, what do you say?
Managed float. No nation would allow its currency to float given the vagaries of the market. So you support it one way or the other and call managed float to achieve your, do you want trouble? So why would you allow your Naira to become 3,000? And where with the government, what would be the implication for security? So Naira is floating as it is adjusted, Ugo, and as it's supported by all of us that we are talking like this and the confidence we are giving to other people. So we are brought from 1,008. What had happened? 1,003, and we came from 700. So what was the magic? We continue to play it, Abi.
Yes, sir. Yes, sir. So, Rotus, I mean, I know this argument stems from somewhere else you and I belong. So, I mean, the conventional argument would be that the Naira, we're operating in managed float. And most people will tell you, depending on where you're reading from, a managed float also means the central bank often intervenes. However, our price, the exchange rate, is determined by the market. So that means the central bank does not influence the exchange rate by fiat. So they allow the market determine the exchange rate. However, if they want to sway the exchange rate, they come in through supply of dollars, which is also a market mechanism for price discovery. Unlike before, where the CBN can say, look, the exchange rate we want is 750, and that's it, and that's going to be the official rate. But here, the central bank is saying, let the market determine the exchange rate. However, we can influence that rate if we improve supply or based on our own foreign exchange policies. And so that's why it's a managed float. In a free float, I believe personally that in a complete free float, the central bank doesn't intervene. The central bank just stays off and only intervenes on special occasions. In fact, it hardly intervenes. And that's what I believe a full free float is. So I think we're operating a managed float process.
Thank you. And yeah, because the Bank of Japan is an example. They haven't intervened since, I think it was 2022 was the last time. They now came out recently to warn speculators because I think the rate was getting to 152 yen to the dollar. So they hinted that they might intervene. So I'm with you on that. Dr. Bumi, there was a question on the African continental free. The questions that keep flying, and you guys have prompted something with the FX question. I saw it and I really wanted to ask you. Basically, the question is on
Looks like Rotus is frozen. Ugodre, I want to take over. Or Praise.
Yeah, hopefully Rotus is able to get back in. Our time is actually fast spent, and I wish we could go on answering the questions and having the debates, but Rotus is back, but I'm afraid to hand him the mic because our time is fast spent. This conversation can go on, and we have these conversations quite often across Nairametrics platforms. But at this point, we do have to say a huge thank you to all our guests for today. If you can, our guests, you can answer the questions in the Q&A box while we wrap things up. And of course, we'd like to appreciate our sponsors for today's webinar. We have the Clenchers, Realtor Limited, committed to revolutionizing the real estate experience and ensuring everyone finds their ideal home for a life of comfort and warm memories. So a huge thank you to them. A huge thank you to our headline sponsors as well for coming through: NMRC, Nigeria Mortgage Refinance Company. And a huge thank you to our panelists who fleshed out the conversation, made it as interesting as possible. And I mean, so much to gain from it. I saw a question in the comment section that they're going, some of our speakers were going too fast. Can they get the recording? Of course. This recording will be made available latest Monday, right, on our YouTube channel. So watch out for that. And I'm sure the link will be shared across our social media platforms. Make sure that you follow Nairametrics on social media, Instagram, Twitter, and so on and so forth. And once again, I'd like to thank every single one of our panelists, Dr. Abiodun Adedipe, Dr. Bumi Bajomo, Professor Nokoya, and of course, Praise. I would love to say your surname, but I don't want to murder it. So a huge thank you, Praise, as well, for making yourself available on this platform and for this webinar. Like I said, it's been made available on YouTube, so make sure you're subscribed to Nairametrics YouTube channel. And thank you so much. Final words, Rotus?
I'm just glad my internet is working, and so I say goodbye and thank you, everybody.
All right. Okay, Ugodre, right, signing out. Enjoy the rest of your weekend, guys.